When you have inflation, assets go up in value. You just started the show talking about California. Your mom bought a house, $80,000 or $70,000, and it went up to $1 million, right? That's because over time you have inflation. So if you own assets over time, no matter what kind of blips happen of ups and downs in the economy, recessions and peaks and whatever, over time, your assets are going to go up in value.
Lots of stuff going on in the news today. We obviously have the horrific California fires. They will likely be having an impact on California and the folks of SoCal for years to come. We have Trump's inauguration, 6 short days away. We have a Fed meeting at the end of January. We did just get PPI reading, which was worse than last month, but better than expected, if that makes any sense. So thought I would talk with the one and only Anna Kelly. We kind of break down what we see for the rest of the year, how she might be positioning herself, and then maybe even talk about what might be happening to real estate values in Southern California going forward. So Anna, lots of stuff to talk about. Any particular interest to start with?
I think maybe we just start with the fires and just, recognizing how horribly devastating it is for the people of California. I get tired of seeing things, bashing Hollywood, and it's all these rich people losing houses. I can tell you, I know people who are not wealthy, who live in that area of California, who have lost everything. I know personally 4 people who've lost their homes, or their parents have lost their homes, modest homes that they've been in for, 40, 50, 60 years in their family, and they're just gone. So, no matter how much money people have, it's devastating to lose everything. And so my heart goes out, to all the people there. And unfortunately, they're just getting worse. It's hard for them to contain them. So our prayers need to be with them. But, obviously, first and foremost, we care about people and loss of lives and loss of, everything that they have, loss of their pets. But I've also thought a lot about, what does this mean for the future? How do they rebuild? Can they rebuild, at anywhere near what they might have their homes insured for, at some point? And what's going to happen to property values in that area and taxes as people leave, and insurability, and I've got some firsthand information about a friend of mine that wanted to move out to California, found a beautiful home kind of away from where the fires are, but they absolutely could not get insurance for less than, I think, $15,000 or $17,000 a year on a primary home because of fires that had happened before this event. So, these type of events, not only are they tragic in the lives of people today, but I think you have, a decade or more of pain that lingers because of the fact that these fires are, happening today. So maybe we can talk through that a little bit, and how it might impact real estate values, if that's of interest.
Yeah, no, I think it is. And again, if we remove the human element, which is horrific and all of that, and we just think about the properties, the first thing that comes to mind is there is a lot of money in that area. Mm-hmm. And the reason I bring that up is because a lot of people are saying that real estate values are going to crash. Actually, Ken McElroy put out a video, I think the last couple of days, saying it was going to crash. And I had a dozen people ask me to review it. And I actually think the next 6 months, you're going to see an artificial bump in prices. In
short-term artificial.
Yeah, I don't know if it's artificial, but basically what's happening, folks, is you have some very rich people who are frankly price insensitive, who want to have a home for their kids to go to school in. They want some sense of normalcy. So, they maybe lived in the Palisades, and the money's almost no object, if that makes any sense. They're going to go to Brentwood, or they're going to go to some other area that was unscathed, and they're going to be bidding wars. There'll be freaking bidding wars, in my opinion, on move-in perfect condition homes. And if that hasn't already happened, it's going to be happening in the next 30 days, in my opinion.
Yeah, and what I don't know, so I don't have any knowledge to base this on. These are just some thoughts that I have. I don't know. I know there are thousands, tens of thousands of structures that have burned down now. So it's a lot of different neighborhoods.
The last number I have is 12,000.
12,000. Okay. Homes. And so there's a lot of different neighborhoods in that area. I've actually been there a couple times in the last couple of years because a good friend of mine lives in Malibu. Thankfully, she's a little further north than where the fires are, but not very, far. So I've been through that area, not too long ago. And of course you see the beautiful homes on either side of the coastal highway, on the water and the other. But when you go back further into the neighborhoods, a lot of those, when I look at the homes, even though they're expensive homes, they're worth, they're much smaller than my home here. And they're considered modest for that area. So what I don't know is, of the 12,000 homes that burnt, how much of them are for that area really above median income, above median priced homes versus those that are below. So I tend to think, this is just my thought process for right or for wrong, that whatever homes are owned by, let's just say the stars, the people that we know, that money's no object, those high-end homes where we've had kind of this reversal nationally where the high-end homes are kind of coming down because that move-up buyer goes away when rates go up. When you have people that can pay cash in high-end homes, absolutely. I think it's like, let's go shopping. We'll pay cash. We'll figure it out. And they buy, the multi-million-dollar home up on the hill, and they go to things like Hollywood, Brentwood. But the question is, for all those that are median price for that area, I think of people that I've seen on the news, and a couple of people I know personally who either lost or their parents have lost a home. They were modest homes. So my guess would be that many of the people that lost homes and those that I've seen interviewed on television, that this was their life savings. They bought it 50 years ago. They're probably not insured for what the rebuilding cost is. And I think you might have a significant number of the people in those fires who don't have money as no object. And so if the supply is really low, then those people that do have insurance money that kicks in, or they have other sources, then they're going to have to pay more, to move than probably their house was insured for. And that's going to make, for a short term, the prices go up. But I just don't know how much supply there is of those types of homes, and whether the price is impacted significantly if you're median or below for that particular market. So tell me what you know about the area, the homes, the demographic, and how that might, I just think it's important not to get a broad swath when, just like every other part of the country, like we see a big difference in below median price, and then the higher priced homes in terms of, are the values going up or down?
No, that's actually step 2 to this equation, and it gets really hard. So step 1, I do think I think what's going to happen is price insensitive demand is going to come in the market very quickly. And we're going to see bidding wars on $1 million properties. And that will make the numbers go up, in the short term. So let's call that 6 months or less. Now, when you go out further than that, this is where it gets really bad, really unfortunate. I did some research about a fire in Colorado. It was called the Marshall Fires. Now, until yesterday, I knew nothing about this. I didn't even know there was a fire called the Marshall Fires. But the reason I looked into this is they had some numbers about folks that were underinsured, right? So it turns out that roughly 83% of the homes that had insurance proved to be underinsured. Right. Now, again, I know nothing about this fire, but I do know Southern California at some level. And if you think about the building costs in Southern California and what's happened over the last five years or so, while 83% is ungodly high, I have to imagine that in Southern California, it's going to be over 90% of folks that are underinsured.
I suspected that might be the case. Even just looking at, property insurance in Florida, where I have a couple of properties, in Texas, Louisiana, the other side of the country along the water, so many people, insurance more than doubled over the last year or two. In some cases, more than doubled each year in the last, year or two. And the only thing you can really do is underinsure. So, some insurance companies won't let you, but some are like, hey, the max amount you can get for hurricane coverage is $250,000. And if a hurricane comes, we'll pay that. And then you're on your own for the
self-insurance.
So, how many of these people already maybe dropped their fire coverage completely because of the cost that went up over the last couple of years because of fires and how many are underinsured. I bet it's a huge number, to your point, Michael.
It's so again, I don't, because again, I've actually had insurance claims. I've had 4 fires and 1 flood in my properties over the last 30 years or so. So this is why I think it's going to be longer term, right? So if you have an insurance policy and you find out that you're underinsured, this is what happens, roughly speaking, right? So you file a claim, adjuster comes out. Let's just say it goes smoothly and you get the maximum, whatever the maximum was.
Mm-hmm.
Let's say the maximum's $1 million. But then you go get bids to rebuild and all of that, and you find out it's $2.5 million. Mm-hmm. Because of regulations and pylon or whatever.
And that doesn't even count price gouging for all the people that are going to rush over there, the fire hunters, right?
It's going to be a disaster. Mm-hmm. So now you're this homeowner. You're staring at this lot of, it's probably by this point it's cleared, so it's just a lot. And you have $1 million. Let's just assume for a minute you don't have a mortgage. We'll take mortgage into account next, because this is where it gets really sad.
Oh yeah.
You have $1 million. You have a blank lot. It's going to cost you $2.5 million to rebuild. What most people will do is they will take the $1 million. They will sell the lot. Let's say they get $1 million for the lot. They will take that $2 million. And my guess, Anna, is a large percentage of those people flee California.
I agree with you.
Right. So that's that. So they're like, I'm done with this place. They're going to blame who they're going to blame. They're going to be pissed off because all their memories and photos, they're going to be angry. They're going to be angry.
Oh, for sure. For sure.
Bounce.
Yeah. I agree with you. I've had fires as well. And I did the exact same thing. At one point I was very well insured, but the replacement cost, once you add in new zoning rules, and listen, California has some of the most stringent, rebuilding zoning rules that I've heard of because of things like climate change and green, everything.
Earthquakes.
Right. It has to be stronger, has to be energy efficient, et cetera. And so all those things are make it, when you go to rebuild, a lot of times a significant piece of the cost is just the bringing it up to current code versus what your home was, which was, usually grandfathered in. And so, here just in Pennsylvania, I had a situation where I think, I bought a home for ballpark. It was a 4-unit, and I bought it for under 300,000. Let's just say 275. I think that's pretty close to what I paid. My insurance was 425,000. And it was going to cost like 600,000 to rebuild. And I'm like, why would I rebuild and pay 600,000 for a building that's never going to be worth more than 350 or 4 if I had to resell it, at that point, when I could go, take it, and pay off the mortgage for part of that. So that was a piece of yours that's really important that you can't miss, is they don't get all that money. They still have to pay off the mortgage, which might leave them with, let's say they had an 80% LTV loan on their primary, which isn't unheard of. They might get, 20% left of what the insurance money is. So let's say that $1 million is down. Well, let's just be generous and say 500,000 that they have. That could be a down payment on something. But to your point, then they've got to go, they probably can't rebuild unless they're very wealthy and they have way more money than what insurance gave them. But they're going to say, where can I take this money and get a home in an area that I like? And then they're going to be dealing with insurance that is going to be crazy, and they know it's going to continue to go up. And the other thing is, I think for Californians, and again, I don't know the numbers on this, but I've heard and read stories about it. Already you've had an exodus of people out of California. And when you have a lot of people leave, and similar to, other areas like New York City, after the pandemic, when people leave, there are fewer people left to pay taxes, and the cost of their taxes is going to go way up. And the more people leave, the more they have to raise taxes on the people that stay. So with a combination of, hard zoning, high insurance, and high taxes, people do say, Uncle, I'm out. And we've already seen them. They leave California, they go to Nevada, they go to Texas, they're leaving Florida and going further up north or in the middle so that they are not dealing with just the insurance and taxes issues there. So the repercussions are regardless of how it happens, whether it's taxes or insurance, and that combination of all of that, you are going to have a huge shift in affordability in California. Absolutely, no doubt. And I know it's a large state, but any of the areas that have fires, which I believe they're pretty much with the dryness all over, you're going to have your cost of living go up significantly. And I bet rents start going up a lot too, because the people that can't buy for a while, or rebuild, they're going to need to rent. And I've already seen stories
It's already
of
happened.
price gouging for rentals. But when you have a lot more demand and a lot less supply, and at the same time, landlords know their taxes and insurance have gone up, it's not going to make it nicer for the renters either. So I really feel for California, whatever your views are on California, and I think that their cost of taxes are just going to go crazy. One thing I read that shocked me, Michael, and again, this is not me trying to play politics. I'd be ticked off whether it's GOP or the left in charge of a city or a state, but that the fire chief came out and I was on the news saying we've been asking for a doubling of fire stations and the budget because the population grew, I think they said, by 55% in the last decade. Their calls went up 55%. Maybe population went up more than that. Calls went up 55%, but yet they just had a $17 million cut this year for fire and $100 million cut for fire across the state. And they couldn't even answer the calls they currently had. And then, they ran out of firefighters, hydrants, et cetera. So they've got to fix that. And if they're going to double the fire, which I think the people will demand, double the money to the fire departments, which they'll have to do for insurance to stay reasonable, because insurance companies are going to be like, you don't have firefighters there where it's even more of a risk. I think that they're going to have to pretty much double the taxes just to pay for, appropriate fire control. So I think it's going to be really, really difficult for California for a very long time. And for those that don't care about California, like, hey, I'm not there, not my problem. If you think that your insurance rates aren't going to go up no matter where you live to help offset the billions and billions of dollars of losses these insurance companies are going to take, you, my friend, are definitely mistaken. It's going to impact all of us.
Yeah. The other thing that kind of hit on about California and the folks that are just going to have enough and leave, some of it's going to be financial. I don't know if a lot of people realize this, but let's just assume you were a school teacher and you bought a home in the Pacific Palisades for, I don't know, let's call it $300,000 in 1982.
Yeah.
People don't realize there's this thing called Prop 13 that makes that home or taxes only go up. I think it's a maximum of 1.3% a year. So even if your next door neighbor paid $10 million last year, your taxes are low. This is how you can have people on Social Security and pensions and be school teachers and policemen, and how they can live in an area where the median home price is $4 million is because of Prop 13.
I did not realize that, Michael, but it makes sense. But wow, now those people's homes are gone. And so wherever they go by now, they're going to have a significant jump in their insurance, even if it's the same price.
Oh, they absolutely can't afford it. I mean,
wow.
This is not,
not insurance, taxes.
Yeah.
Taxes.
So never lived in Southern California, but I have real example in the Silicon Valley. So my parents bought their home in Sunnyvale. I believe, let's call it 80 grand. It was like 77 or 78 when they bought this. And I lived there until I moved out when I was 18. And my mother sold that, I think, in 2014, 15 maybe, for $1 million. And it wasn't, I mean, it was a 3-1, never updated kitchen. I mean, she had a garden hose to, dump the water out of her washing machine because the pipes are, I mean, it was bad. But somebody paid $1 million for that. You know how my mom could afford to live there? Because she was paying property taxes on a $70,000 house.
Wow.
Even though there were $3, $4, $5 million homes all around her.
Right.
But now if that house burned down, she couldn't afford to live there. She couldn't
Wow.
afford to live there.
Wow.
So
An eye opener, Michael. I mean, it's wonderful for older people that they don't raise their taxes to the extent that values can go. That's a wonderful thing, but I've never really thought through, well, what happens if they all lose their homes? Yeah, it's so sad. Because again, one of the people that I know, his 80-something-year-old mother just lost her home. And, I thought, well, that, hopefully she's got insurance and she can, buy a home comparable. But wow, I had no idea. I had no idea.
It is impractical. Now, again, it's possible that they, do exceptions and, hey, if you were impacted by the fire, you can move your tax basis. So, I mean, there's all things
even if you went from
80,000
to 800,000, I mean, that's a 10 times increase just in your taxes alone. Yeah. People move out of California for sure.
Yeah, it's going to happen.
Yeah.
And then the other thing, again, I'm using Florida as an example here. You might remember this. I don't remember which one it was. There was a hurricane that hit Punta Gorda, the west coast of Florida, probably 2 or 3 years ago. Do you remember which one that was?
I don't remember the names anymore.
It was a hurricane.
Yeah. Mm-hmm.
But the reason I bring this up is we are just now, 2.5 years later, I believe, seeing active inventory hit the market that says damaged, fixer upper. Because again, what we're going to have a short-term bump in prices, but over the next year or two, you're going to start to see distressed stuff because people are going to realize impossible to build. It's too hard. Don't have the money. Can't afford to do it.
Yep.
And the last thing I'll say about this, and this almost makes me feel ill, is we're going to have a bunch of, I'm just going to call it Wall Street money for the lack of a better term. They're going to just come in and start land banking lots.
Yep. 100%.
And they're going to just land bank and land bank and land bank. Then they're going to get together around the table and they're going to trade properties because what they're going to want to do is it's going to be freaking monopoly lived out in real life. They're going to try to create the board where they control this part of the city or, I control this block or that block or whatever.
We'll build your new neighborhoods. Yeah.
And it ain't going to be for you and me, right? You and I are, richer than
all
most.
That land sitting on the water, you're not going to have the people who had a modest home who've lived in that neighborhood for years. It's all going to be the wealthiest of the wealthy, high rise. Well, who knows what they'll allow them to build, but probably, all very, very wealthy.
It'll be gated communities for the 1% of the 1%.
Mm-hmm.
That makes me ill. That makes me sick. So
it really does. So yeah, I just my heart goes out to the people, and I think as much as we can do good, maybe we can all go and just as an act of kindness, go contribute to someone's GoFundMe. The 80-year-old widow who lost her home. Just do what we can to help people tangibly.
There you go. Well, let's try to switch gears. We got a couple of more topics to get into. Again, dealer's choice. We could talk about Trump's inauguration and what might be transpired after that, or we just go Fed and inflation. Which one do you want to go next?
Let's go Fed and inflation.
There we go. So we do have a Federal Reserve meeting at the end of the month. I believe the last time I checked, it was a 98.2% chance that they will go on pause. We've got Bank of America. Not sure if you saw this. Bank of America saying no cuts in 2025. We've got JP Morgan and Goldman saying not 3 cuts, but 2. We have a PPI reading this morning, which was good and bad, right? Up, but not as up as expected. CPI tomorrow is going to be a barn burner. If expectations, we're going to go from a low of 2.4 all the way up to 2.9. That doesn't sound like inflation getting better. What the heck does the Fed do? Says Anna.
Michael, part of getting older is realizing that the more you know, the more you realize you don't know. I think I've said this before. I think you and I have done a really good job over the last couple of years at looking back at history, looking at what history tells us is likely to come, and really diving deep into the data as it comes out, calling BS when the numbers are, fluffed, when the numbers are propped up, or they're just not very good indicators anymore, and trying to make predictions. So I think we've done a really good job at making educated predictions, yet we've been wrong on the timing, whether we'd have a recession. Again, I truly believe
I was wrong twice.
Exactly. And I truly believe that for the most part, America is in recessionary type conditions when it comes to the average American who is, struggling. However, at a total combined level, we've not hit 2 negative quarters of GDP, other than the once when it wasn't called, even though we did. More recent history, we're essentially maintaining at a fairly healthy equilibrium. I'm going to say healthy in air quotes, but just in terms of the pure number of inflation and unemployment, they're fairly balanced right now. And this is the risk for us. So my thought that we're recessionary, I think we still have a lot of potential pain that could cause us to go into a recession quickly. And I'll just point at 2 things. One, we have the highest number of corporate bankruptcies and bankruptcies of small to mid-sized businesses since the GFC, and that number is continuing to go up. And number 2, we have consumers who are completely tapped out, a lot of debt. We're seeing an increase in defaults and student loans that just kicked in that are just going to start reporting this month on credit reports. So those 2 things, along with the risk to the banking system of rates staying higher for longer, more bonds and more commercial real estates having to be written off, potentially creating insolvency for the banks, those things could create significant risk, which if they happen, Michael, rates will fall. The Fed will be forced to stimulate. Fiscal policy will be stimulative. Monetary policy will be stimulative, meaning the Fed cuts rates and the government pours a bunch of money, just like they always do, to get you out of a recession. But barring that happen, assuming that we continue in this status quo where unemployment is relatively low, and it is today. Yes, there's lots of risks, but as a total percentage, teetering in that 4.2, 4.4 range, that is relatively low. And as long as CPI is relatively low in the 2 to 3% range, that looks like a soft landing. It looks like a fairly stable economy to the Fed, to the government. And that's all that matters, is what do they think, right? And that means that you have rates stay the new neutral, kind of higher, maybe similar to where they are. That higher for longer could be higher for a lot longer. And
I agree.
So that is kind of, I feel like a call that I did get right is that I said, I feel like we're more in a stagflationary environment than we are a true recession. And even if a recession comes and goes, my call was over the next decade, we're basically living in stagflation, where we've got some growth, we've got some strain, we've got inflation that's higher than it used to be and isn't going back to 2%. But we've also got just enough stimulus to where things stay flat. And stagflation is very difficult for governments to get you out of. And you see that when the Fed started cutting rates, but yet the Treasury market, went higher, mortgage rates went higher. It's because they're concerned about inflation over the longer term being much higher than it has been. And the reality is, with Trump in, the inauguration is next week. Okay, so we are going to touch on it just for a second, right? A lot of the things that Trump is planning to do to try to stabilize the U.S. economy for the long term are very inflationary in the short term. It requires a lot more government spending, and we can't afford more government spending, right? But if we can't raise taxes, which he's not likely to do, and you can't cut expenses, which is not likely to be able to happen, the only option for the government, and this is fact, is to allow more inflation than they want to tell the American people they're allowing. Because if they can kind of cause more inflation without people railing against the government because of it, and make people think we're basically okay, then it's cheaper for them to pay off that debt in the future with future dollars than it is today. And every country in the world has done the same thing. They allow more inflation. And so I believe inflation is here to stay, at least for the next decade.
Oof.
It's going to feel very stagflationary. And it with the exception of a meltdown that hopefully is temporary, I think rates are going to stay higher. And I hate to say it. I wish it wasn't true. I have, my livelihood is mostly commercial real estate, right? My mortgages in the next year or two, I was smart. I extended as long as they let me for 5 years, 7 and some. I'm going to have mortgage payments double, Michael, over the next year to year and a half, almost 2 years. That's going to cut my cash flow in half that I live on day to day. And thankfully I'm okay. But it is the reality that at least right now, the way things look today, it looks like rates are going to stay kind of where they are. And you have FOMC members saying, we think we're pretty much at neutral. And so, that's a reality I think we have to digest. But with that said, there is so much that happens that's beyond what we have expected. And things outside of the Fed's control. Geopolitically, so much has happened since COVID and all these wars that are happening that we're involved in by proxy or by money in some capacity, that it's making the way that things generally worked historically to predict the future very difficult to predict. And that's the reality is I don't know. I don't have a prediction beyond until something changes. I think we're in for a very flat decade and a lot more like we've experienced this last year.
Yeah, I think there's a lot of truth in all of that. And again, I was out early saying no cuts in 25. I still believe that higher for longer. I've called for average 7% mortgage rates. So I've kind of been here for a while. So it sounds like you're joining me, which is awesome. I think the first 6 months of the year are absolutely no rate cuts, right? There's just too many cross currents. And I do think, again, we'll get to Trump's inauguration in a minute. A lot of his early policies, right, executive order kind of stuff, will be without question inflationary, right?
Absolutely.
At least in the short term. So it is very likely, again, that we have no cuts in the second half either, right? Because again, it's a timing thing. Right. We get all of these policies. They get talked about on the 20th and 21st of January. They start ripping and rolling by March, April. We could have some ugly inflation prints in the middle of the year.
See, I don't think it's going to happen that soon because, again, if you think about rates and what rates do, they trickle through the economy very, very slowly. And we've talked about this on the show the last couple of years. A lot of economists, they say at least 12 and a lot of times up to 18 months after. So the Fed rate cut of a quarter point, we didn't really see the impact of that for a year and a half, even though they're looking at every month and going, oh, we're going to be, we're going to look at what's happening and we're going to react to the data. They're reacting to data that they know is really created by the policies and interest rates that were there a year ago. So I don't like the method they're using in the first place, but the point being that impacts on money getting into the system, whether it's money supply from money printing. So for your example, if Trump said, okay, we're going to create a bunch of jobs. You're going to, create a bunch of jobs. They're going to start making money. They're going to start spending money. That's going to be inflationary. But just to create those jobs, by the time you have the legislation, it also takes a year to year and a half for them to start actually moving on those things. And then it might take another, once the money's in the economy, another year, let's say, to see the real impact of that. So I don't think you see the real impact of Trump's new policies for a year and a half to 2 years at best. You might have the treasury market.
I think
you might
you're wrong.
Have the bond traders. I don't think so. Tell me why.
Well, because again, I think we're already seeing it. We have this thing that I think it was Greenspan, maybe it was Bernanke, this thing called animal spirits. And we have already seen, we've had 2 NFIB surveys, small business surveys, December and the one that just came out this morning, now at a 6-year high. Because what's happened? Small business optimism.
Yeah.
Hiring optimism.
Sure.
Buying product, buying inventory, optimism. So again, what's going to happen in the first 6 months of Trump? You're absolutely right. Nothing the government does, no monies, no appropriation, none of that stuff will hit the system. Doesn't freaking matter. If we go from a pessimistic, government is in my business, don't want to expand, too risky, to an environment of, oh my God, capitalism is back. Let's go do something. Let's do this. Let's do that. That is instant. And we already saw the first report, the JOLTS report last week came in shockingly high. And I called it because, again, it's just belief. People will invest ahead of it.
Sure. But here's the, as many things that you're seeing positive reports, there's just as many small businesses that are not optimistic. They're struggling now. They've been hanging on to their employees as long as they can. So while there might be more hopeful, and listen, the stock market absolutely rip-roared. But what's happening now that they're seeing, we might have higher inflation, we might have higher interest rates, we might not be able to go and refinance this debt that we're holding on to. And inflation isn't good for businesses because it squeezes the population and what they can spend. I was listening the other day to Stephanie Pomboy, an interview that she has. She's she runs Macro Maven. She's a macroeconomist. And I could go a lot of different tangents there, but just one thing that she said, and I'm probably going to get the percentage wrong, but it's close. Okay. The Mag 7, right, allowed the stock market to go up 30%, right? The Mag 7. But of the S&P companies, when you take up over the last year, it's about 12.5%. If you take out the Mag 7, it's actually it's like 3%. It's pretty anemic. Flat. But when you look at small companies, and you look at consumer discretionary. Okay. So all the stocks in the S&P 500, two different things she said, all the stocks in the S&P 500, consumer discretionary, including Amazon, was up 12.5%. Stock values up 12.5%. If you take out Amazon, consumer discretionary companies are down 3%. Yep. Amazon makes up 15% of the aggregate. So I just don't want to lose sight of it. It's not that I'm completely disagreeing with you, Michael, but the reality is when you look at the companies, there are certain companies, certain stocks that are doing well. They reposition their debt. They're excited. But when it all comes down to it, the question is the consumer better off today than they were? Are the policies that are going to be put in place going to make the consumer better off? Because all we can spend is what the consumer can spend. So you can have all these animal spirits in the corporate world, in the 20% of the haves, right? Which include you and I. Those that have money, it's like, okay, our investments, we're going to figure out how to make money, right? But the 70% that's still living check to check, they're not getting better yet. And that's going to take time. So I believe that when it comes to consumer discretionary stuff, that is the heartbeat of what Americans spend money on in consumerism. That stuff, I don't think you're going to have the smart consumers who are living check to check, but they're actually, not just blowing it on $200 tennis shoes and big screen TVs. They're still going to be pulling back until they see it hit their pockets, until their wages go up and inflation comes down, or they can tap their equity at a reasonable rate. They're tapped out, Michael. So I try to have a balanced approach. I don't think it's as bad as I thought it was going to be and that we're going to go into as deep of a recession, but I don't think it's as good as the markets are hoping for. I think we're still going to have a lot of volatility because of the reality that all of the things that could happen that are making me, quite frankly, more optimistic about the future than I was before, right? All of those things take a long time. So just like the interest rate cuts were long and variable lags, the money that created this problem, the government created this problem with the helicopter money. It's long and variable lags. The stimulus, the excitement, it's long and variable lags. So I would disagree with you that it's going to be so rip-roaring great in 2 quarters. I think it's going to be kind of more of the same. But yeah, and again, I hope I'm wrong.
No, it'll be interesting to watch. I think the first 2 quarters will surprise people to the upside.
Yeah.
But again, I'm wrong all the time. See my last 2 recession calls. So
Well,
hey,
I think something that's healthy about these kind of discussions, right, is that like you and I both know more than most, okay, in terms of we've been doing this a long time. We've created the wealth. We've lived in the system. I've been in banking. I've been in, I know how the institutional investors think and the family offices and what they invest in and how different it is from my family who are living at average or below income levels and what it looks like at boots on the ground. And what we've learned over time is that the financial system is extremely complicated. And even the wisest, economists and money managers and, guys like Jamie Dimon and Warren Buffett, they've been around a long time, and yet their calls can be very different.
yeah.
Their perspective is different depending on the niche part that they play in the economy and what they see. And all of us, all of the economists, the macro guys, the micro guys, the big hedge fund managers, they've all been shocked at how few of their predictions have actually materialized in the short term and how long it's taking to try to figure out this mess, how many things are happening that we didn't expect that are prolonging or changing those views. And I think these conversations are very healthy, but I think something that a takeaway, Michael, is that the economy is complicated. And, you and I both preach this, preaching to the choir. You have to understand the economy, because if you don't understand where we are, you can make some big mistakes that can completely derail you financially for a long time. So it's important to listen to different voices with different experience and say, this could happen or this could happen. And I think you and I have done a good job at saying, we could have a future that's more inflationary. Mm-hmm. We could have a future that's, a depression, not likely, the government's going to try to do everything they can to prevent that. But we could have a future that's just very, very flat. And I will say that those who I listen to, guys like Ray Dalio, Jeremy Grantham, David Rosenberg, there's just so many of them. Warren Buffett himself have said they believe we're going to have a flat decade, and they made that call 2 years ago, and they're not backing off the call. They've pulled out, they've sold at the top, they're sitting on cash, and they're saying, look out, the economy is precarious. There's a lot of volatility. There's a lot of unknowns, and therefore you have to be really careful to make sure that whatever you invest in, you're getting a good enough risk premium. Back to our video that we talked about last week, like, if you're going to take risk to make a return, you've got to be wise. You've got to diversify, because we just don't know what's going to happen and when. But with that said, you asked at the beginning of the show, with our economic calls, what are we doing to hedge? What's the difference? So one of the things that I would say, again, assets, when you have inflation, assets go up in value. You just started the show talking about California. Your mom bought a house, $80,000 or $70,000, and it went up to $1 million, right? That's because over time you have inflation. So if you own assets over time, no matter what kind of blips happen of ups and downs in the economy, recessions and peaks and whatever, over time, your assets are going to go up in value. So I am still excited about and bullish about real estate. However, within that, if you own assets that are their values are dependent on interest rates, such as commercial real estate and cap rates. If you think we're going to have more inflation, look at what just happened with the 10-year Treasury. Regardless of the Fed's rates, if the bond market and the Treasury buyers think that we're going to have more inflation in the future, those rates are going up. And that means that your cap rates potentially could go up, which means values fall. And so I, as a commercial real estate investor and a residential housing investor, I have shifted, and I think I've said this on the show, from buying big value add, large multifamily to buy and hold, which was how I built my bread and butter, was buy and hold. And I'm doing somewhat smaller properties, like a 4-unit building its values are, dependent on the income, but they're not as dependent on cap rates because they're more based on sales comps, right? So buying smaller properties, again, I've bought some more single families over the last couple of years. That single family homes over the long term, you and I've looked back over 50 years and done all the spreadsheets. On an inflation adjusted basis, they go up 1% per year on average over 50 years, right? After inflation. And so hold assets. I'm still buying real estate. I still will buy real estate, and you can make money in real estate in any market, just like we talked about in last video. The other thing is gold and silver. Those are hard assets. And as the dollar and other global nations' currencies have a lot of volatility, and we're seeing that, and I think we're going to see more of that. Assets like gold and silver that have a proven value, that have gone up in value, for the most part. There's ups and downs, just like anything else. But like, I was sad that I missed out on the market rally, because I really thought we were going to have a recession much deeper, and we didn't. And I'm like, man, if I'd put money in, I did. I made some good bets. I made some bad bets, but I didn't put much in the stock market. And I'm sad that I missed that. But my gold and my silver that I bought a couple of years ago have gone up and beat the returns of the market. So I was happy with my gold and silver. So, I think we need to understand that no matter what happens in the economy, when we're not sure, hard assets like real estate and gold and silver do really well. And income producing assets where you can provide a business of some sort to people that people need, not the discretionary stuff. So we just talked about discretionaries. Like, I would not be investing in or buying companies that their products or services are completely discretionary until we see some of what's going to happen through these lags. But what do we provide? We provide housing, food, shelter, energy. Those are the big things that people need, and that will continue to go up in price and value if you can provide those assets over the long term. So that's kind of my thinking about the so what of if I get the call right or wrong. If it's more recessionary, real estate does well in recessions. Providing housing does well because people need a home, and they'll prioritize that. If it goes up in value, great. My real estate, my gold and my silver, they're going to go up in value too. So, I think that's just, hopefully that's helpful to like put the theoretical stuff into play. Like, don't give up on real estate, gold and silver. Continue to buy it. Continue to buy hard assets. And I think no matter what comes, you will do well.
Yeah. And then the last thing, we got a few minutes left. Trump inauguration, 6 days away as of this recording. I think he's going to do quite a bit of executive orders. I think it's going to be market moving. I think I think by Monday evening, we're gonna know what's a priority, what's important first, and buckle up. I think it's gonna be a ride. We'll see what kind of ride, but it's gonna be a ride. That's what I expect. I expect lots of energy, a lot of action. A lot of chaos, right? I think the market's going to lose its mind. Like, this is good. This is bad. What's this mean? What's that?
Absolutely.
He's going after Greenland. What?
Oh,
it's going to be crazy.
It's been crazy. I feel like I'm living like in Alice in Wonderland the last couple of years. Like, it's just getting curiouser and curiouser, right? But yeah, I think that the country as a whole, again, it's hard because it's kind of 50. We're pretty well split, into liberal or conservative. But I think a lot more people are moderate, Michael, than the news wants us to believe, and wants the same things for our country, right? Good wages, affordable housing, affordable health care, safety, our homes protected by the fire departments, insurance that's reasonable. I think we all want those things. And I'm very hopeful that at least I see, and again, I know some fans have called me a MAGA doomer because I was negative on the economy. And you and I've talked personally, like, I don't like Donald Trump as a person. I don't. Right. So I'm not like this, like, I love Donald Trump person, but I'm optimistic about the future. I will say this. I was very pleasantly surprised that he reached across the aisle and is filling his cabinets, members with some Democrats that disagree with him on some things, some conservatives. It's not like all the far right. It's like he's trying to bring together a coalition. So I'm
he's trying to build a super team.
Yes, and I'm thankful for that. That's something that I can give him. That it looks like he really is trying to say, listen, we learned. He had a good economy, until COVID. We've learned some of the things we need to tackle. And I'm hopeful that I start seeing executive orders on things like affordable housing. How can we make it fair landlords and for tenants. How can we make it more affordable? How can we tackle, wages and inflation and jobs and safety and lowering crime? So I'm looking forward to what those executive orders are. I'm hopeful and positive about the future of the country more so than I was before. But I'm also not thinking that like he's going to save us in the next 4
No,
years.
there's no,
we've got a long way to go.
We got work to do.
We've got work to do. But never bet against America, right? I'm an American, and I'm pro growth and pro America, and I hope that the next several years are better for all of us than what the last have been economically.
Anna, where can people find you?
You can find me on your show every week on social media at Anna Kelly, REI Mom. And if you're looking for real estate and financial coaching and consulting, you can find my website, AnnaKellyInvesting.com, where you can get on my calendar.
Thank you so much. Have a great day.